Order types. Now in this video we are going to see different conditions followed in the orders. The first one is the time condition. We have two conditions there. One is a day condition and another is a IOC. A day order is nothing but a simple order which is valid for the market close, which is valid till the market closes. The market timings is from 9:15 to 3:30. So when you enter a day order, the market will be valid till 3:30 p.m. The next one is IOC. IOC is immediate or cancel. Now traders may use this IOC order in case of very big orders or in case of intraday orders. Now what is IOC? As the name indicates, the traders may want their orders to be executed or matched immediately. If any of the order quantity is not getting matched, that particular order quantity will be cancelled. So for example, if a trader is entering an order of say 1000 shares and he wants it to be a IOC order, then that 1000 shares, when it gets into the market, when that particular order gets into the market, it finds a match for 1000 shares. It is getting a match only for say 600 shares. The remaining 400 shares will be cancelled. Only the 600 shares will be matched and it will be sent as a trade. It will be registered as a trade. The remaining 400, that part of the order will be cancelled. So that is called as a immediate or cancel order or IOC order. The next condition is the quantity condition. We have something called as DQ. DQ is disclosed quantity. Now if anyone wants to conceal their original quantity, then they can use DQ. For example, a trader might want to enter a very big order, that is say for 1 crore shares. Now if he enters that order for 1 crore shares, it will be seen in the electronic order book by all the other participants. It is transparent. Now if other participant sees that big order, then he might send something and he might think that okay, somebody has entered a very big order, so something is happening within that company, so I will also buy it. So traders will think similarly and they will also start buying, and the price of the share, that particular share, might start to increase. And the original trader who had entered that 1 crore quantity order might not get the shares at his desired price. So he might want to conceal his original order quantity of that 1 crore. So he can use that DQ condition. So in the DQ condition, he can mention only 10% of his order, that is 1 crore. 10% of 1 crore is 10 lakhs. So he will mention 10 lakhs in DQ. So if he mentions 10 lakhs in DQ, the order will be seen as a 10 lakh shares order only. It will not be seen as a 1 crore quantity order. So a big order will be executed in batches. So whenever the other participants see, it will be seen only as a 10 lakhs order and not as a 1 crore. So DQ condition is used to conceal very big order quantities. The third condition, price condition. Now we have different price conditions. First one is market. Now if you want to enter any order with a market price, it means that you are willing to buy that share at the prevalent market prices. You are not specifying any price. So if you enter just as a market price, it means that you are willing to buy it at any price prevailing in the market, subject to certain conditions, subject to a range. The next one is limit. If you specify a limit price, then it means that you are not willing to buy above that price. For example, if you specify 100 rupees as the limit price for any share you want to buy. It means that you are willing to buy up to 100 rupees, not even a paisa above 100 rupees. So you will get your shares only if the shares are available at 100 or below 100. It will not be executed. Your order will not be executed if the share price is even 100 rupee 5 paise. So this is the meaning of limit order. So limit order is when you specify the price. Market order is when you are willing to buy it at any price. Okay. Now the next one is stop loss orders. Now we use stop loss orders only when you want to cut your losses. Now consider this example. You have already bought the share at 100 rupees, expecting the share to go up, expecting it to appreciate. But in reality, the stock price is going down. So imagine this situation. Now if it goes down, you want to cut the losses to only 5 rupees. So you already bought it at 100. Now you want to cut the losses at 5 rupees. 5 rupees means 100 minus 5, it will be 95. So 95 is the trigger price, and you would mention a rupee lower as the limit price, probably 94 as the stop loss limit price. Now what it all means, trigger price will be 95 and limit price will be 94, and your purchase price was 100 rupees. So whenever the share price comes down to 95, a sell order will get into the system at limit price 94. So this stop loss limit order will actually sell all your shares at the prevalent market prices with the limit price as 94. So you will send a sell order at 94, but it will be around some 95 because the trigger price is 95. So the market price will be around 95. So it will be sold around 95. So this is how it works. So you are buying it at 100 rupees. You are putting a protection there by using a stop loss sell order at 94, and the trigger for that stop loss sell order is at 95. So this is called as a stop loss sell order. Now the stop loss buy order would be greater than this 100. Imagine that you have already sold that particular company share at 100, expecting that share price will go down. If it goes down, then you are in profits, then there is no use for stop loss buy order. But if it goes up, then it will be a loss. If it goes up, then you put a trigger price at 105 and a limit price at 104. So whenever the stock price reaches 105, a stop loss buy order will be triggered into the system, and that stop loss buy order will be triggered with a limit price of 104. So this is the logic of stop loss orders, and stop loss order is an example of a price condition order. And the last condition, other conditions. Under other conditions you have two. The first one is proprietary, the second one is client. So if the order is entered on behalf of the trading member itself, a broker can trade with his own money for his own benefit. So if any broker is sending an order for his own money, then that is called as a proprietary order, and that will be labeled as PRO. And if it is a client order, it will be CLI.